Hey everyone and welcome to this explainer. Today, we're going to unpack the completely predictable ways that capital behaves when the Federal Reserve aggressively raises interest rates. Between 2022 and 2023, the Fed hiked rates literally faster than they had in 40 years. They took the federal funds rate from essentially zero to over 5% in just 18 months. It was a massive, dramatic shift. So today, we're going to look exactly at how the wealthy navigate this kind of environment and how they completely bypass the panic that most people end up feeling. So let's just dive right into this crazy contrast because it's pretty stark. While ordinary Americans were watching their mortgage rates double, their credit cards climb past 20%, and just feeling generally miserable about their finances, the wealthy actually got richer. Seriously, during the exact same period. And look, this isn't some accident, and it's definitely not a conspiracy. It's really just a transfer mechanism. Money is simply moving from the people paying the interest over to the people collecting it. It's exactly how capital behaves in a high-rate environment, and it plays out like this every single time. We're going to climb the ladder of complexity today. Here is our roadmap. 1. The Great Wealth Transfer. 2. Upgrading your cash. 3. Becoming the bank. 4. The Real Estate Contrarians. 5. Buying corporate distress. And 6. Betting on the collapse. Let's jump right in.
All right, Section 1. The Great Wealth Transfer. Let's talk about positioning yourself on the right side of the transaction.
First up, we really need to establish a foundational truth about how the wealthy actually view these rate cycles. The Fed has been managing interest rates since 1913, right? Raising them to cool off inflation, cutting them to spur growth. These cycles happen roughly every 7 to 15 years. They are entirely predictable. So the crucial takeaway here is that if you know a cycle is coming, you can position your money to benefit from it rather than just suffering through it. To the wealthy, high interest rates are absolutely not a crisis. They're a transfer mechanism. They treat managing their money as a professional sport. They know that capital just moves from borrowers to lenders, and they make totally sure they are standing on the collecting side of that equation.
Moving on to Section 2, upgrading your cash and escaping the retail bank trap.
We're going to start with the absolute simplest strategy, yet most people never do it, just because they don't know it's an option. Get this. In 2023, while the average person left their savings sitting at a big retail bank, the 4 largest banks in the U.S. were paying out a remarkably generous, and by that I mean genuinely insulting, average interest rate of just 0.4%. Yeah, 0.4% on a standard savings account.
Meanwhile, the benchmark rate was sitting way up above 5%. So what did the wealthy do? They immediately yanked their cash out of retail checking and dumped it into money market funds and treasury bills. These T-bills are direct obligations of the U.S. government, and they were yielding 5% or more. And here's the real kicker. Treasury interest is completely exempt from state and local income taxes. So if you're a wealthy resident in a high-tax state like California or New York, your effective yield is actually way higher when you factor in those guaranteed tax savings.
And this brings us to a little something called net interest margin. It brilliantly illustrates exactly why banks make an absolute killing during these cycles. It's just the spread between the 0.4% the bank paid you and the 5% they earned by lending your money out, or literally just parking it with the Fed. Because of this massive spread, banks like JPMorgan Chase reported nearly $50 billion in net income that year. Let that sink in. If your money was just chilling in a standard savings account, you were the product.
So how do they maximize this? The wealthy use short-duration bond ladders. It's super simple. You just buy bonds that mature at different intervals, say 3, 6, and 12 months. It functions exactly like a relay race, perpetually passing the baton. As soon as one short-term bond matures, boom, you immediately reinvest that cash at whatever the highest current rate is. You're never locked in for years on end. You're always riding the crest of the absolute highest short-term interest rate available.
Okay, Section 3, becoming the bank. We're getting into private credit and direct lending here.
Now we're stepping into a world most folks honestly never see. When the Fed jacks up rates, traditional banks get super nervous. Their regulations tighten up and their appetite for risk just shrinks. But guess what? Businesses still desperately need capital to run. So who steps in to save the day? Private credit. This is direct lending from wealthy individuals or private funds straight to businesses. These private lenders move way faster than banks, they don't have the same regulatory headaches, and because the borrower was already turned away by a traditional bank, the private lender gets to extract way better terms. And here's the magic word: floating interest rates. That means when the Fed raises benchmark rates, the interest the borrower has to pay goes up automatically. The lender literally makes more money without renegotiating a single piece of paper.
During the 2022 to 2024 cycle, the Cliffwater Direct Lending Index showed private credit funds generating 10 to 13% net returns on debt. 10 to 13%. Sounds amazing, right? Well, here's the catch. The structural math means the strategy's really only accessible if you already have millions to play with. You need enough capital to safely absorb the fact that your money is going to be tied up. These funds can be locked up for years, and yes, borrower default risk is very real. I mean, if you have $20 million, locking up $2 million is just a slight inconvenience. But if your net worth is $200,000, locking that up is impossible. This right here is a prime example of how the wealth gap just naturally compounds itself.
Section 4. The Real Estate Contrarians. Let's look at buying the dip in a frozen housing market. You'd think high interest rates would totally crush the real estate market, right? But nope. Existing homeowners simply refuse to sell. I mean, they are sitting pretty on 3% mortgages from 2020 or 2021. If they move, their monthly payment basically doubles. So inventory collapses. Regular homebuyers get squeezed out by 6 or 7% mortgages, which forces them to keep renting, which of course drives rents up even higher. But wealthy cash buyers, they don't care about mortgage rates. They have zero rate sensitivity. They swoop right into the void, scooping up distressed properties, from divorces, bankruptcies, relocations, at a steep discount. They rent them out at those newly elevated prices, and then they just chill and wait for rates to fall so they can refinance into a much more valuable asset. It's a win-win for them.
Moving to Section 5, Buying Corporate Distress, or How to Profit from Overleveraged Companies.
This is where we see the big money capitalizing on companies that basically partied too hard and borrowed too heavily during the zero interest rate decade. Suddenly, money got expensive, and they're drowning. In a high-rate environment, wealthy investors execute a rate trade using something called preferred stock. This sits right between common stock and debt. It pays a fixed dividend and gives you priority in bankruptcy. When interest rates shoot up, newly issued preferred stock has to offer higher dividends to compete with safe government bonds. That forces the price of the older, lower dividend preferred stock to drop. So, what do the wealthy do? They swoop in, buy up this older stock at a massive discount, lock in the fixed income, and just wait for the price to bounce back up when interest rates eventually drop again.
Now, for the companies that actually hit the wall and default because they just can't service their debt, enter the distressed debt investors. They're often cheerfully referred to as vulture funds. They buy up the failing company's bonds for pennies on the dollar, maybe 40 or 50 cents. From there, they basically just rely on one of three mechanical outcomes. 1, the company somehow survives, the bonds return to face value, and boom, the investor doubles their money. 2, the company goes bankrupt, the debt is restructured into equity, and these investors literally become the new owners for a fraction of the cost. Or 3, the company liquidates, the assets get sold off, and as secured creditors, they usually get back way more than they paid. It's basically a self-correcting machine that turns corporate pain into serious profit.
And finally, Section 6, Betting on the Collapse. This is the two-sided trade of the rate cycle.
This final mechanism is definitely the most aggressive. It focuses entirely on sectors that were engineered exclusively for a low-rate world. Take regional banks, for instance. The collapse of Silicon Valley Bank back in March 2023 was, at its core, a devastating rate mismatch. Back in 2020, the bank loaded up on long-duration bonds. But when the Fed hiked rates aggressively in 2022, the value of those bonds just completely tanked. By early 2023, depositors realized, hey, I can get 5% yields in money market funds, so they all pulled their cash at once. Squeezed from both sides, the bank collapsed. But here's the crazy part. While ordinary folks were watching the second largest bank failure in U.S. history in absolute shock, some hedge funds had already positioned themselves for the fallout.
They did this through short selling. These investors mechanically analyzed bank balance sheets, spotted the structural vulnerability to high rates, and set their trap. The steps are surprisingly simple. First, borrow shares of the vulnerable bank. Second, sell those shares immediately at the current high price. Third, just wait for the inevitable squeeze to cause the stock price to plummet. Finally, buy the shares back dirt cheap, return them to the original owner, and pocket the massive difference. They legally executed a trade that paid them extraordinary amounts of money precisely as the bank was failing. You see, the rate cycle really is a two-sided trade, but usually only the wealthy have the access to play both sides.
So as we wrap up this explainer, you now have a real look under the hood at the mechanics of how capital moves during a high-rate cycle. You've seen exactly how money flows away from the people paying the interest straight into the pockets of the people collecting it, whether that's through simple money market funds, complex private credit, or literally betting on structural collapses. The wealthy don't panic when rates go up, they just reposition, which leaves us with one vital question to think about regarding your own financial positioning.
When the next cycle rolls around, which side of the transfer mechanism are you going to be sitting on?